Well, first of all, private equity is an established group of investors in Central Europe. You see people populating all segments of the market, from venture capital and kind of small buyouts through mid-market to large buyouts. So it is a proven market, and it seems a very attractive market, especially for Western European large buyout groups. More recently, it is also a source of interesting investment opportunities for both strategic investors and other private equity funds, as the portfolio of existing players mature and we start exiting from our deals. So it is an established player. It is increasingly competitive, and while we all are expecting a lot of interesting bargain opportunities in upcoming years because of the financial crisis, we also will be facing challenges like availability of debt financing for buyouts, as well as the portfolio companies which will be struggling with tougher economy. But long term, we believe it's a very attractive and interesting region where a lot of companies, consumers still have space to grow, because these markets will be converging with Western Europe. Absolutely. Over the last few months, we see an increased pipeline of new projects. Stock exchange historically has been the toughest competitor to Innova and generally to private equity, because it provides growth capital to mid-sized companies, which are our target, and it also is providing liquidity for those who want to cash out. So right now we see that absent of vibrant stock market for a while, people are turning more to strategic investors and private equity. So we are hopeful that this situation will stay for a couple of quarters. But long term, we obviously are pleased to have Warsaw Stock Exchange as an alternative for our exits. So net, it's good to have a solid stock market as a competitor. The financing is still there. There are two themes right now. One is the quantum of debt, so how much the banks are willing to provide financing, and our fund has historically been quite conservative in terms of the amount of leverage we've been taking. So we were raising our eyebrows in terms of how much historically banks were happy to lend. Right now, I would say it's back to normal, but it may have impact on valuations that private equity can pay for the targets. The second theme, especially in the mid-size and large buyouts, is syndication risks. That in the past, banks were underwriting. One or two banks were underwriting the whole financing package, and then they were selling it to small banks that don't have such huge firepower, but they're interested in taking part of the debt financing from the buyout markets. Right now, banks are not really willing to underwrite big tickets, because they are concerned that they will not find the buyers for part of the credit. The solution for that is so-called club deals, where 5, 6, 7 banks get together and they basically provide the whole financing package, and they end up with part of that which they are willing to continue for the next 4 or 5 years. So they don't take this underwriting and syndication risk. So far we have not seen a meltdown in availability of that financing, and people who are present at this conference, quite impressive group of banks that have attended, they all are open for business in Central Europe.